volatility remains elevated as the market grapples with a plethora of global macro issues. Implied volatility rank, or 4 rank for short, is a good way to see if the current level of implied volatility for a stock is high or low compared to the last 12 months. And 4 rank of 100% means the current level of implied volatility is the highest it has been in the last 12 months. And 4 rank of 0% means the current level of implied volatility is the lowest it has been in the last 12 months. When 4 ranks is high, it can be a good idea to look at option selling strategies such as naked puts, bull put spreads, bear call spreads and iron condors. The parameters for this screener are 4 percentile above 70%, market cap above 40B, total options volume greater than 20,000. The parameters for this screener are as follows. I customized these slightly from the Barkhart default preferences. Potential annualized return, 15% to 35%. Market cap above 40 billion. Days to expiration 15 to 45. Last trade time within the last 2 sessions. Security type equals stock and ETF. Option volume greater than 250. Open interest greater than 500. Moneyness minus 15% to minus 5%. Bid price greater than 0.50. One way to take ownership of a stock for less than the current price is via an option strategy called a cash-secured put. A cash-secured put is a slightly less bullish trade than buying the stock. It is considered a neutral to slightly bullish trade. A cash-secured put involves writing an at-the-money or out-of-the-money put option and simultaneously setting aside enough cash to buy the stock. The goal is to either have the put expire worthless and keep the premium or be assigned and acquire the stock below the current price. Selling put options is an easy place for investors to start with options. They are like a covered call and are pretty easy to understand once you know the basics. Traders selling puts should understand that they may be assigned 100 shares at the strike price. Naked put example. Let's use the First Bank of America naked put as an example. A trader selling the April 14, 37 strike put would receive $82 into their account, which would be theirs to keep. If BAC stock falls below 37 by April 14, they would be required to buy 100 shares at 37. The effective net cost of the position would be 36.18, thanks to the option premium received. That is 11.84% below yesterday's closing price. If the stock stays above 37 at expiry, the put expires worthless, leaving the trader with a 2.3% return on capital at risk. That works out to be 23.6% annualized. The main risk with the trade is similar to outright stock ownership. If the stock falls quickly, the trade will suffer a loss. However, the premium received will help to offset the loss. The maximum loss on the trade would occur if BAC fell to $0, which would see the trade lose $3,618, but most traders would cut losses long before then. Cash-secured puts are a great way to generate a return on strong stocks, potentially without ever having to take ownership. If the put does get assigned, the investor takes ownership with a reduced cost base and can potentially begin selling covered calls to generate additional income from the position. However, they can be risky and are not recommended for beginners. Beginners may prefer to trade a spread such as a bull put spread. Bull put credit spread screener. To execute a bull put spread, an investor would sell a naked put and then buy a further out-of-the-money put to create a spread. A bull put spread is considered less risky than a naked put, because the losses are capped thanks to the bought put. Let's use the first Tesla, TSLA, trade as an example. This trade involves selling the April 800 put and buying the 770 put. The maximum profit is $8.40 per spread, with $21.60 being the maximum potential loss, for a potential 38.89% return. The break-even price is $791.60 and the spread has a roughly 66.3% probability of success. Barcart's naked put and bull put credit spread screeners can be a great way to find option trade ideas.